You are listening to
The Actuarial Business Podcast.
with MJ, the fellow actuary.
Hey everyone, it's MJ and welcome back to the podcast. Now I know we've been away for the past 2 weeks, and that's because I was giving some lectures on enterprise risk management and also unfortunately had the flu. But we're back, and the topic for today is people risk. Are people the number one risk to business or to any type of organization? And the reason why I'm making this podcast is not only, like I say, have I done these enterprise risk management lectures for the Actuarial Society. And so this podcast can be something I can share with those students just to be a bit of a deeper dive into the specific risk around people. But also, as you know, I am creating my own startup, and I'm at that phase now where we've got the funding and we're employing the team. So we're building up a team, we're picking people, and I want to be very mindful of the risks around this entire activity. Now, of course, the actuarial philosophy for risk, especially the enterprise risk management philosophy for risk, is that risk is both upside and downside. So think of a dragon guarding a pile of gold. There must be the upside, which is the gold, the opportunity. There's also the downside, the dragon, and that is the danger. And so that's why I'm putting forward that people are the number one risk, but not just coming from a very negative or pessimistic, like, oh my gosh, they're the ones that could sink your company. But no, they're also the ones that make it float. They're the innovators. They're the genius. They are the ones that drive the ship forward. So with all of that, we're going to jump into people risk. And I think a nice way to maybe do this podcast or to structure it, because sometimes, I can talk and I can get a little bit off the beaten track, is to follow the risk control cycle. So the risk control cycle is, as the word says, it's a cycle, and it all points towards the risk profile. The risk profile of the company. Once you know that risk profile, you can then make decisions. So it's part of the whole governance system. If your risk profile is greater than your risk tolerance, maybe you need to slow down. You need to, decrease your exposure. But if your risk profile is less than your risk appetite, then actually you need to take on risk. You actually have room and capacity for more, active decision making that will allow you to maybe go into new markets or do something that, you're chasing that pot of gold. So fight bigger dragons. So this risk control cycle, very critical tool with regards to corporate governance. And how it works is, step one, you want to just be aware that there is such a thing as risk, something that sometimes actuaries and other risk professionals take for granted, that not all people are that aware to risks, especially how we define it and the intricacies around it. So risk awareness is the first step, and that's also where you're making your risk statement and you're starting your whole risk document with regards to reporting. You're stating, this is our appetite, this is our tolerance. Now let's measure the risk profile. Step two would be identifying risks. That's when you create that whole risk register and you organize your risks into the different categories. And yes, traditionally, actuaries, we did underwriting risk. So that's risk around mortality and morbidity and longevity. But then we got into more catastrophe risk and accidents for non-life insurance. And then you got into the financial risks of markets and credit. But in enterprise risk management, we also bring in operational risk, which essentially is people and systems. So people is a big part of that operational risk, which is part of all the bigger risks. We're not going to talk a lot about measuring people risk today, because that is incredibly nuanced depending on the type of business that you have in play. So depending on your business, you're going to have a different set of tools and techniques to measure your people risk. So rather, we're going to spend more time talking about how to manage people, or manage the risk around people, because I think that's a bit more generic. And of course, we'll end off by talking about monitoring. Now, I want to keep this very, very high level, because I mean, I could end up speaking for hours and hours on this topic, and I'd rather have this podcast be too short than too long. Of course, you, the listener, are aware of what the final length of the podcast is. I'm at that position where, we're coming into 5 minutes. So let's jump into the meat of it. So let's start with being awareness. Let's just be aware of people risk. So if you're aware of humans, and again, this might be something actuaries are a little bit more aware of or think about more than the general population, and that is mortality, the fact that humans die. I know death is one of those topics you don't really bring up on a first date or you talk at the dinner table, but as actuaries, because a lot of our ground mathematics is based on life tables, mortality is always at the top of our head. And it's important to be aware that when you're working with humans, or even the fact that you're a human yourself, we can get sick, we can get tired, and we can die. So essentially, we can stop working. So whatever system or process we're part of can be disrupted by our death. It's also maybe an important thing to realize, like if you're in factories and in the industrial sector, safety is also critical. The idea that humans can die, compared to say robots, where you just replace their parts. Humans, you can replace an organ here or there, but normally if sustained injury can lead to death. So important just to be very high level aware of humans dying, getting sick, tired, stop working. But look, we can also make actions that are detrimental to the business, and they can be unintentional. We can call those mistakes. Someone pushes the wrong button, they issue an instruction for a call option instead of a put option, and then they double the risk exposure instead of reducing it, and that can be catastrophic to the entire organization. So something to be mindful of. And then, of course, there can also be intentional action that is detrimental to a business, and this is corruption. And again, in finance, there's so many cases of, we even refer to them as rogue traders. Enron's a good example where people do the wrong thing, knowing that they're doing the wrong thing because they're putting their own self-interest above that of everybody else, in front of that of the organization. So I'm going to just use the word corruption for that, but I know there's a whole psychology around why they do it, and because they got upset, or there's greed, or they saw a fault in the system and they just had to be curious enough to see could they get away with it. But essentially, humans can take actions that are detrimental to the business. Humans can also get lazy, bored, start losing interest in their work, and we can see a decrease in their competency. Of course, humans can also learn and improve, and we can see their competency increase. Because remember, there's upside risk as well. And speaking of one of the big upside risks is humans are smart. We're geniuses, genii. You can see I'm not one, because otherwise I would know what the correct term was. But we're intelligent, and we can be sources of innovation, and innovation is a huge upside risk that I think many businesses just don't appreciate. So source of innovation is a great thing to be aware of with the workforce. Of course, coming back to maybe, I don't want to say a negative one, but one just to be aware of, is that humans are emotional. And I think this is why a lot of economics, especially Ecos 101 that we learn in first years, is flawed, because it's based on this assumption that humans are rational and that humans will always act in their best self-interest. And when you get to my age, you realize, no, that is not the case. Sometimes we will act against our own self-interest. We will act in ways that seem very irrational, and it is because of this emotional factor. We can maybe focus more on the short term when we're angry. We might, not take risks if we're feeling scared, even though our business has the capacity to do it. We might become greedy. We might become overconfident. There's all of these emotions that can impact how we work and increase the unpredictable nature of the people that you work with. And also, I think it's good to be aware of, that people respond to incentives. If you say, hey, you're going to get a reward for doing this, then that is going to see an increase in happening. People are going to push towards that. So we do respond well to incentives as well as to punishments. Fear is a big driver that some businesses use in order to control their workforce, because they're aware of how we respond to it. So I think it's very good to be, to delve into psychology, to be aware of the different elements that make up humans, to see that we're not just robotic, blood and blown machines that can just be plugged into various systems, but we have our own nuances that need to be considered before we, get the best out of us. So now that we're aware of humans, and it's such a weird thing, to speak about humans, being a human myself, let's now jump to the next step of that risk control cycle, which is identifying risks. And as I said, I want to go on the record for saying people are the number one risk to a business. In fact, any type of organization, I would say people are the main risk. And people, I'm splitting them into three categories. You can split them into whichever other ones that you want, but I've got supervisors, internal and external. And as supervisors, these are the people that we need to report to. These are the people that have very strong influence over us, whose decisions we kind of need to adhere to. So right at the top, you've got the government. And I guess if you're in a country where your president is a little bit unpredictable, you're going to have political risk. Or there's a lot of people fighting for that position at the top, that instability risk and all of that. And how's that going to filter down and impact your business? You've also got the regulators. Regulators are people, at the end of the day, and the rules and regulations that they set are going to increase, the compliance risk that you have as your business. Of course, not all businesses are regulated, but most businesses have some sort of shareholder person, or the person where they're getting their funding from. And if that person ever decides to pull the plug, or they decide, our capital can be deployed better elsewhere, or we actually think somebody else can better manage the ship, then you as the boss or as the team leader are very, very exposed to that risk and trying to keep the shareholders happy. So government, it's probably unlikely that you can have much influence on them. Although when we go to looking at managing risk, we'll see, especially this most recent Donald Trump inauguration, and just seeing a whole bunch of CEOs from the tech industry sitting there, we will address that maybe even government risk is something that can be managed. I think it's something Elon Musk is doing very actively. But then this is at the Premier League, the top leagues. These are the biggest CEOs in the world. They will have that influence. Even when we took it's called the C100 course. So after you complete the enterprise risk management exam, we have like this finishing course, and we had some of the chief risk officers from Barclays Bank here talking to us, and we were talking to them about political risk. Like, how do we know what's presidents can be unpredictable? What can businesses do? And this guy was very much of the opinion, we tell them what to do. We influence them. And this came as quite a shock. But a few years later, the South African president would come on and speak about this idea of white monopoly capital. And a lot of people were like, what exactly does he mean by that? And I think it was the fact that the business sector in South Africa was still having a very strong influence in our government system. So even though people, we don't sometimes think of government and that it's a person at the end of the day, and their decisions are going to impact our business. Same regards to the shareholders, the regulators. So supervisors are definitely part of that people risk. Normally, though, when we think about people risk, we're thinking internally, and that's the second category I want to talk about, the internal people. These are the team, this is the secretary, this is your boss, this is the person that you depend on to get you coffee in the morning, or, file the reports or engage with certain clients. So your internal team. And again, this can become very, very specific to the business that you're building, and different businesses, different organizations will have different exposures. But generally, there's key person risk, where you're hyper dependent on a certain individual. There's competency risk. that the people in your team actually don't have the skills to do what they need to do. There's competition risk internally, and that was something that you saw a lot with some of the early hedge funds. I think his name was Robert Julian, and he had these things called the Tiger Fund, and he would actually train up people with his strategies on how to get the most out of an inefficient market and actively trading. But it got to a situation where the people he trained up said, well, why are we still listening to this guy? We're engaging with the clients, we're engaging with the markets. Why don't we just set up our own? And they literally called them the Tiger Cubs. I don't know if they literally called them that or they were just referred to in the market as the Tiger Cubs. But they went up, and of course, they copied the strategies and they took the clientele, and they just cut a little bit of the fee, which made it more of an incentive. They had that relationship with the clients, and your workforce essentially became your competition. Maybe that's a very exaggerated case, but it's something to be aware of. Also, your internal team. This is maybe speaking more to Blizzard recently. Having that toxic work environment with a lot of sexual harassment and these things that could then seep over to reputation, legal, and a whole bunch of other risks as well. But essentially, it's a work environment that's not getting the most out of your people, out of your team. And that's why, like I say, risk can also be upside. So it's important to know that there is innovation risk. Your team could come up with a really good way on how to do something and can be a source of a massive upswing. So very, very important to always, like I say, be aware of that upside. And then I've got this final group of external. And I mean, external, you can have very external, like, the protesters. These are people who, let's say you've got an industrial company and you're polluting the river and they're out there with their pitchforks and their signs. You can have them, they can disrupt your production. And I mean, rightly so. If you're ruining the environment, yeah, you should be stopped. So we're on team protester for this one. But it's not just businesses that are industrial and doing things like that. Because of social media, there's this huge social media risk where the reputation can be impacted. And if people are unhappy with your business practices, so let's say something like Blizzard, this huge social media storm, huge reputational damage, and then that's going to impact the other external people that your business relies on. Be it one, the customers. People might say, maybe we should play other games and not support Blizzard until, they've justified or made changes. It could, like I say, even push your customers to your competitors. And I think there's also a thing to be mindful of with innovation risk is that if you don't make the best of the innovation of your team, there is the risk that they leave and they join your competitor, and your competitor then enjoys the source of that innovation. But just by having a competitor, the fact that they can cut prices, they can do things differently, they can, jump on your mistakes, it adds that other risk that, okay, we do live in a competitive environment. And then there's also all the partners and people that you outsource to do various work. And you could have such a situation where, you've got the credit risk. Normally when we think of credit risk, we're thinking of default risk. This is where we give people money and they do not meet their obligation to make a repayment, whether it's in the form of an interest or repaying the entire lump sum. But there's also an element of credit risk known as counterparty risk. And this is when you're depending on someone and they drop the ball and it disrupts your entire process, your entire system. And for businesses, this can be, say, suppliers. And sometimes this is because they just make a mistake or their environment changes. Think of, with the whole Russia-Ukraine situation, how many supply chains were disrupted because of that conflict. So very important to see how, war and governments and these very big external risks are very closely tied to the people at the end of the day and how they fit into the whole system. Like I say, you could have a situation where you're depending on a supplier, but someone in their team, as you say, dies, or is corrupt, or is just having an emotionally bad day, and they don't, deliver your order on time, or they send you the wrong thing, and then that can disrupt your entire thing. So people, it's not just internally, but it's also externally, as well as being aware of the supervisors. So there's a lot of people risk that we need to manage, that we need to consider. But what I want to do is maybe focus in on just a few of these groups. Otherwise, like I said, we could be here all day, especially if we had to do the risk control cycle, measuring, managing, monitoring on each of these specific ones, which a good chief risk officer would do. And that's why a good chief risk officer would most likely have a team of people and would also much be mindful of, if I don't have the right people in place and they don't do their risk control cycle for a specific risk properly, that's going to impact our entire risk report. So they need to be mindful of that. And even, like I said, like a risk such as pandemic risk, the whole COVID risk, at the end of the day, it was people that decided what should happen to economies. Should they stay open like we saw in Sweden? That was a person decision. Or should it be a lockdown? How long should that lockdown be? Should there be any other restrictions, the punishments? All of these things, at the end of the day, were people decisions. And so being mindful of how people operate and how they work can help you understand why certain decisions are made and can help you better prepare and manage to deal with them. So let's start at a very, very high level. So if you're like me, you're starting out, it's a startup, you're creating your own business, or maybe you're a venture capitalist and you're deciding, where you're going to invest your money. So you're at this stage where you're essentially getting to pick what business you want to do. Do I want to put my time and energy and money into business A, or time and energy and money into business B or C, D, all of the ones down the line? How do you decide which ones to do? One of the things I would highly recommend, especially when it comes to people risk, I think the best way to manage people risk is right at the start when you're picking your industry, you're picking your niche, is to pick something where the people are replaceable. And I know that sounds harsh. That sounds like very inhumane. But essentially what I want us to be very, very mindful of is avoid critical dependency risk. Why? Because at the end of the day, we're all going to die. Okay, so we all are going to die. So you either want to, pick a business that is replaceable from a person point of view, whereas if it's all dependent on one individual, then that longevity of that business is, it's going to be very, very questionable. And this can be replaceable across all the levels. So let's look at, say, the supervisor group that we spoke about. If your entire business is dependent on government tenders because you've got a good working relationship with someone in a position of power, anything happens to that person in power, they get, they don't get reelected, or they die, or they get tired, or they just retire, your entire business could crumble. So you don't want to put all your time and energy into a business that depends on one very specific government contract. You want to have a business where it doesn't matter who's in charge, your business can run. If your business is operating in another country because it's expanding, it's not dependent on having good political positions. And again, that can also be with the other supervisors, shareholders. You don't want to build an entire business or organization around a single person of funding. And this can sometimes happen. You could land in a situation where you've got this crazy idea, you're building up your crazy startup, and you're getting funding from either a parent, a family member, or someone who's also got the same shared specific interest in you. But you know that everybody else either won't get this idea, or it's too early, or it's just too crazy, that if it wasn't for that person, your business would not get funding. I would be very, very hesitant to engage in a business like that. And sometimes passion projects fall into that, and I'm aware that, the business I'm forming around is around Pokemon. If it was something more niche than Pokemon, and there was only like a very small group of funders who shared that passion, that is a very critical dependency risk, because like I say, humans can go away, and if you can't have someone to replace, to sub in for that position, then you're in trouble. So even when it comes to funding, you want your business to be so good when it comes to the fundamentals, or have such good cash flow projections that anyone and everyone wants to line up to provide you with funding. If that's not the situation and you're incredibly dependent on it, then, like I say, it's going to be tough. Maybe another example is in the medical field. If you're building a charity or organization around a very, very specific and very, very rare disease, again, you've got that critical dependency risk where if that chief donor disappears, how are you going to continue your funding? And we see this happen more often than not. Also, when it comes to your internal team, if you don't want to build your entire business around a specific chef's personality, and then that chef personality, decides, hey, I'm done cooking and I want to get out of the kitchen and chill on the beach. And now your entire business is built around this celebrity-like persona. You can think of record labels that don't diversify, that don't have a lot of exposure to other things, or just the managers of big celebrities and singers and rock bands. They're incredibly dependent on that artist. That artist decides they're not wanting to do this anymore, or there's a big scandal around them. That business that manages that specific individual will suffer the consequences. Also, like I say, with regards to your team, you don't want to have one specific engineer that only they know the trade secrets, only they know how to create the product, only they can do a specific task. Because once again, they get sick, they get tired, they get bought up by a competitor, and you're not in a good position. I mean, even externally, you don't want to have one set of customers in one very specific market where, again, if anything was to happen and they turn on you, it's game over. You want to have a product, or you want to have a business that can tap into a diversified set of customers, and not just building something incredibly specific. I was doing some karting over the weekend, and if you're making your entire business around creating karting sticker kits, and then for whatever reason, for a specific team, and then that team decides, hey, they're not going to compete in South Africa anymore, and your entire templates are designed for that shape and that body kit, and that's your only customer, and something happens to your customer, then okay, what happens then to your business? And I think this is why reputation and online protesters is such a key risk that you need to manage, because if you have a reputational disaster and there's a social media backlash, that social media follows you. It can be very difficult to try and do something different, try to do something else, because that reputational risk will follow you. And sometimes that can follow the key individual. We see that in crypto. Someone will create a project, they'll do a rug pull, and then they'll try to create another project with a different name, and then people will be like, wait, weren't you the person who did the rug pull? Like, why are we going to back this new project of yours? And that's why some people say, never back a crypto project, or never put your money in a crypto project where the team is anonymous. They just have a weird NFT profile picture and you have no idea who they actually are, because, hey, trick me once, shame on you, trick me twice, shame on me kind of idea. So you want to make sure that everyone is replaceable. Now, either pick your business, so that's that done, or hope that in the future maybe you can implement systems like AI and that. But we're not going to jump down the AI rabbit hole. Those of you who listen to my channel know that I can very easily get distracted by that topic. So we're not gonna jump into AI, because that could be an entire episode on its own. Addressing people risk with AI. Can you do it? What are the residual risks? What's the long-term consequences on society as a whole? Very, very fascinating topic. So one, like I say, best way to manage people is to pick a business where everyone is replaceable. Part number 2 is to control that onboarding stage, to make it very, very strict who joins your ship. You're going on this adventure. There's going to be times when you're out in the ocean, you can't see any land, it's, seasickness, there's storms. You want to make sure that you're on a boat with the best people. So how do we control who gets on our ship? How do we control this onboarding? And essentially, I mean, a lot of the things that I'm going to be talking here are pretty obvious, and it's important that you do the obvious, especially when setting up a business, a startup. We can sometimes forget the basics in startup world. But having an interview, and in your interview, you're looking for essentially two things: competency and cultural fit. In competency, check, do they have the qualification? Maybe give them a bit of a quiz or a question during the interview. Maybe have them complete a mini assignment, and attract them with a big salary. Because you don't want to have a situation where you find the perfect employee and then you're not remunerating them correctly and they don't take the job. Or if you don't have a big carrot to begin with, competent employees are not even going to apply for your position, especially as a startup. Like, you don't realize the lack of goodwill you have when you're starting at zero that all these other companies, these big, well-established companies, do have. So be very, very mindful of also your position when it comes to the interview. It's not just you're interviewing them; in a way, they're interviewing and testing you. And then you want to test for cultural fit. And what do we mean by this word? Oh, we've got a good work culture. Like, what does that cultural word actually mean? And I guess you could boil it down to saying, does the team work well together? And that is, do we have a good set of values and principles that we all uphold, and we all believe in this greater good, whatever we define the greater good as? Or is the system quite hostile and competitive, and we say the bottom 5 performers get fired, and there's only one person that gets promoted every year, and it depends on this and that, and have a very hostile, competitive nature? And in some industries, you are going to have a situation like that. You can think of, like, say, a sports team. There's only so many positions to actually play the game, but the squad tends to be bigger because, of course, we need to manage the risk that someone gets injured, they need to be replaced. But internally, everyone wants to start the game. So there's going to be that internal competition, and that can be healthy or that can be hostile. Hostile can be in the form that they end up poisoning each other the night before the game so that they can get the position. Maybe a bit on the extreme side, where healthy is iron sharpens iron and they push each other to get better. So how are you creating that environment to ensure that everyone works well together? And also realizing that you can have someone that's incredibly competent, but just the wrong cultural fit. And you can look at the whole, Jung had those 16 personality types, which the Myers-Briggs test will try and figure out and sort you and put you into. And you can maybe look at those personality types and figure out how to assemble the team around that, or have a group of people that are psychologically more likely to be in tuned. Some companies have this 3-month probation period, but again, you need to be aware that humans can fake it. Humans can put on a mask, can pretend to be something they're not in order to achieve their goal. Deceptiveness is a unfortunate human trait that it's good to be aware of. But you can also have these orientation programs, and I think that happens a lot when there's grad hires. So if you're hiring a lot of graduates, sometimes their personality hasn't been completely formed, or they're still figuring out what they want in life. There's a bit of indoctrination that can happen in an orientation program to say, this is how it's done here. You've got this job, so this is who you need to become. And I think humans are adaptable. We become what we're needed to be, especially if we're picked up at a very early age. I think the earlier we are, the more we're moldable into specific things, where it's easy to take a graduate through an orientation program than, say, a seasoned executive. But what businesses can also do to control who joins is they can project a reputation. Goldman Sachs can say, hey, Goldman Sachs, work hard, get paid big money, and now they know that they're projecting this reputation of saying, hey, if you want money and you're smart and you're prepared to work hard, this is where you need to come and work. And so by having a strong reputation, not only is it good for your customers, attracting your customers and getting into a better position with maybe your shareholders and the government and all of that, but it can also get people to say, hey, I want to go and join that team. So reputation is critical. How your company, how your organization is perceived in the eyes of others is a great way to know, okay, what is the overall people risk? And that's why I know we did skip measuring people risk, but measuring sentiment on social media could be a good proxy to understanding your holistic people risk. And I mean, just coming back to Goldman Sachs, it's interesting because, they can sometimes say, hey, big money, but it's not just money that they're offering. They're also offering status. It's kind of like you get to brag, oh, I work for Goldman Sachs or JP Morgan or one of these big firms. It carries a lot of social credibility that individual can then carry into their friend groups. And like I say, when they go on a date, they can be like, oh, I work for Goldman Sachs. It can be a positive for them. So what we see is that businesses don't just have to incentivize people with money. In fact, I think money is a weird thing. If you desire money, what that just essentially means is you don't actually know what you want, because money gives you opportunities to do essentially anything. So if you're desiring money as the ultimate end goal, it's like, you don't actually know what you want. And I have friends like that. They're like, this is my salary target. I'm desiring this salary target. I don't care what work I do, what firm I work for. I want this salary target. Where it's better to maybe have a little bit of self-reflection and say, what exactly do I want? What do I actually want to do in life? And it can be a great question to ask your team. Now I'm hiring people to join Pokecoin, and it's a key question I want to ask them is, what besides money, what else is it that drives you? I might not be able to offer that status that JP Morgan can do, where they're like, you're a vice president of compliance, and you're vice president of sales, and you're vice president of getting everyone coffee, but people can be like, hey, I'm the vice president of this big financial firm. And sometimes the title people desire more than, like I say, a salary increase, because of the implications that'll have on their own social settings and stuff. So maybe your workforce wants status. Maybe your team wants travel opportunities. And that's quite a cool thing, with Pokecoin, being in both crypto and Pokemon, and there's the Pokemon tournament that's happening all around the world in various countries, and there's all the crypto conferences where it's a great place to market and make connections and find investors and new markets. There's a lot of traveling opportunities within Pokecoin. So it's much better for me to find a team that wants to travel, that gets excited by travel, and travel becomes a positive thing, rather than, say, finding some team players that might be incredibly competent, but they've got a family, maybe they're scared of airplanes, or they just don't want to leave beautiful South Africa, even during the worst of winters. That person might not be the right fit for a business like ours, where traveling needs to be done. So rather find people who want to travel, and then that travel becomes a positive rather than a negative. Maybe people want to learn. So maybe someone says, hey, I want to join Pokecoin because I want to learn more about crypto. I want to learn more about this technology. I want to learn more about the system. And then it's like, okay, this is a great learning opportunity. Maybe somebody wants flexibility. They want to work from home, or they want to be a digital nomad, or they don't want to always have to come into the office, or always have to, come in at certain meetings every, morning, Monday morning, 8 a.m. team meeting. Like, maybe they don't want that. And hey, as a startup, you can have that flexibility. You can work from home because, we don't have offices to save on that expense. So find a team member that wants that, or it could be, again, you don't want someone who's highly competent, but then they want order, they want structure, they want an office environment, they want that Monday morning meeting at 8 a.m. and they want it every single day because that's how they function. So understanding who your team is will help you pick, like I said, the right person. And maybe time. As a startup, we might not be able to offer the biggest salaries. We might not be able to compete with the JP Morgans when it comes to salaries, but we can compete on another way, and we can say time. Say, okay, instead of working 8 hours a day, or one of these big financial firms, 25 hours a day, come and work for us, and it can be just, say, maybe 4 hours a day. something like that. We can maybe offer you more time, more holiday leave, maybe a thing where, okay, we need you to travel for this conference or this tournament, but part of your perk or part of you coming on board is that you also get a week's leave whenever you travel so that you can actually enjoy whatever country you're visiting. Having these other ways to incentivize your team rather than just money can be a lot cheaper and more efficient in the long run. Also, your competitor can always offer more money, but your competitor can't necessarily always offer the same experiences, whether it being travel, learning, flexibility, and that, especially if they're bigger and they're more, their systems have crystallized. So as a startup, be mindful that you have other sorts of ways to incentivize your team and not just salary. And in the day, you can actually create an environment that's fun and that's where you want to be in. And I mean, we can go more into having tight legal contracts and clearly defined roles and responsibilities. And yes, always good to have that. But let's maybe jump, because like I said, mindful of time. And you could talk so much on all of these things. We're focusing mainly on, like I say, the internal team. But when it comes to the supervisors, we mentioned earlier with Donald Trump and his inauguration and all of those CEOs. And I think they had to pay quite a bit of money in order to be at that inauguration, or there was something like that. But we do see that in business when it comes to, supervisors. The way to manage that relationship is through having relationships, through having open communication, and also through, I don't know what's the right word to use here, because you could label them as donations, you could label them as gifts, you could label them as bribes. And of course, there's a lot of ethics and internal rules and regulations on what you can do regarding business gifts and that, because you can imagine if you go to a government official and you wine and dine them and you treat them to something absolutely amazing, they're more likely to say, hey, that's the business we should choose for our tender. But it doesn't even just happen on the big scale. I mean, coming back to actuarial science, if you're an actuary and you're advising the trustees of a pension fund which asset manager to go in, and you're sitting in on these meetings and an asset manager walks in and gives each trustee a nice leather moleskin diary and a Mont Blanc pen and, has this really great show and compliments everyone and, just says all the right things. And everyone's like, oh my gosh, we love this guy. We need to go and throw all the pension funds at this asset manager. You as the actuary have to be like, hey, past performance, not an indicator of future performance, and their investment philosophy doesn't align with ours, or even if it does, look how high their management fees are. They're like 10% higher than everybody else's. Maybe we shouldn't go that way. When you're talking about pension funds, management fee is huge. So for an asset manager to spend a little bit of money on a leather moleskin and then get an extra, a few basis points on the fee, it could be a very smart investment on their end. Or when you look at, say, Formula One, when they come to get sponsorship, from a supervisor, from a funding person, they'll offer in, oh, the CEO can drive our car during one day, or we'll get box office tickets at the events, and it'll be wined and dined. And again, it's the CEO or the decision maker has now got this conflict of interest, because of course they want this amazing experience, but is this the best thing for the shareholders? Is this the best way to market it? Or maybe it can be worked in a very positive way. The shareholders might say, listen here, according to our financial reports and the systems and policies we have in place, we can't be seen to be paying our CEO too much money because of the gap between the CEO and the factory worker. So what we'll do is we'll give the CEO a very low salary relative to what they should be getting, but we can spoil them with all of these sponsorship deals so that they can go and live their high life. And hey, maybe that's what our CEO wants. They want to be at these high networking events. They want to be at a Formula One circuit. And that's what they would have spent their money on anyway. So this way we can sponsor a team legitimately, report that he's getting paid a low salary. The factory workers don't protest because the salary looks in line, not realizing that they're getting these benefits that could be worth over $1 million, driving Formula One cars, traveling to outrageous venues. There's many different ways on how it can be done. But coming back to, and I guess like it's interesting, like how the shareholders and the funding for one company kind of seep into how they can maybe retain their CEO, their leadership. You can see how a lot of the ways you manage people risk is a little bit intertwined. But I think retention is critical, because even though we said you want to have a system where people are replaceable, you want to avoid that critical dependency risk, it's also very important to be aware that it is expensive to replace people, okay? It is expensive to orientate, it's expensive to find, it's expensive to interview, it's expensive to market the position. It's expensive on the team morale. If people are leaving, then people are more likely, the ones that stay are more likely to leave. And people tend to, one person leaves, then everybody kind of follows, and then you want to plug these gaps. So retention is critical. And you want to listen to your team's needs. There's basic things. There's this story, I don't know if it's a myth or if it actually happened, and I think I actually read this in the DK Big Ideas business book, which I didn't consult for this podcast, but I think I read the story there, where the CEO of Toyota was complaining about why is the business not doing well? It was like, well, because we had poor sales. And they said, well, why did we have poor sales? And it was like, well, there was actually quality issues with the product we were creating. Why were there quality issues? Well, our development was interrupted. Why was the development interrupted? Well, because some of our key engineers left, key engineers left. And why did our key engineers left? Well, because they actually wanted a new coffee machine, and we never actually got around to fixing the coffee machine, and it turned into a fight, and they left in a huff, and so essentially they left because of coffee. And it's a crazy, and like I said, that's why I think it's a made up story, but it's this idea to show that a very small cause, such as bad coffee or no coffee in the work environment, can have this butterfly effect that results in huge amounts of dollars lost through lost sales, because it causes the engineers leave, which causes development interruptions, which causes quality issues, which then releases to poor sales. And could all have been avoided if you listen to the team and were like, oh, let's just get them a nice coffee machine. I mean, it can also work not just on the negative, but on the positive. So in South Africa, we had a situation where a young actuary was working at one of these big life insurers. They came up with this really cool idea on how to do medical aid. And this life insurer was like, nah, we're not going to listen to you. You're young. We're going to stick to how things are always done. And they disregarded their innovation. That actually would then leave, create a huge company called Discovery, which is one of the big companies on the South African stock market. I even have shares in them. I love Discovery. And it was this thing where this other company could have captured all of that value, could have captured all of that innovation, that market growth, but they didn't, because they didn't listen. And fortunately, this actuary had the business acumen to actually execute on their idea. Because a lot of the times, you can have people who've got great innovation, but don't know how to implement and execute. And this is why, as a CEO or as a team leader, if you can listen to the innovation of others and you know how to implement and execute, you're going to do a lot better than someone who doesn't listen and get that innovation from their team. It's a little bit counterintuitive, because if you ever study Machiavelli, he was very much of this opinion that if you want to control an organization, if you want to rise to the very top, if you want to become CEO, the last thing you want to do is disrupt the powers that currently be. The last thing you want to do is introduce chaos through innovation. Instead, you want to play by the rules and slowly but surely work your way up to the top. But if that's the case, then it means the current CEOs and leaders that we have in many businesses lack the innovation to push them forward. And I think that's why there's still a huge market for startups. That's why VCs aren't putting their money in public equity, and they're realizing that there is more growth and value to be captured in private equity, specifically at the startup stage. And you can also be proactive. You can just have a fun working environment. That's something we're trying to foster at Pokecoin, is having it fun. It must be something where you enjoy the work that you do. If you're not enjoying it, we don't want you to be part of our team. We want everyone to enjoy it, make sure they're in the right position, they're having fun, and that it doesn't feel like, oh my gosh, this is horrible work, but rather, hey, this is really cool, this is exciting, we're building something great together. Now, when you have a little bit of capital, you can have team offsites, but there's also soft ways of doing it. Maybe having the Friday, the first Friday of every month, having time off. When I was working for Polygon, that's one of the things that they did. Or maybe having internal competitions. World Cup comes up, have a bit of a fantasy league, have a bit of a prize for the team. And that can be a great way to divert that competitive nature that I think is in a lot of us into something trivial like, World Cup fantasy team, rather than focusing in on each other and seeing each other as the enemy in the workforce, rather seeing each other, hey, we're friend in the workforce, we're enemy in our fantasy kind of thing. And I even worked for a company where 4:00 every afternoon we played Call of Duty. And I think it was a way to try and get us to shoot each other in this virtual game and not try and take each other out, but we're all trying to compete in various positions to try climb the top. And also at this company, we would have game night once a month as well. Also a nice way to just do that team building. So risk management isn't always defensive. Like I said, it's the dragon guarding the pile of gold. I think the risk manager is holding a sword and a shield. The sword are the proactive things that you can do. The shield are the defensive things that you can do. And then to complete the metaphor, I always say the armor is the amount of capital you need in order to survive a dragon attack. But being aware that if you have too much capital, you're going to be too slow, or the shareholders are going to be like, is this an efficient use of our capital? So you always want your armor not to be too heavy. Like if you guys ever play Elden Ring or Skyrim, if your armor's too heavy, your character's not as nimble as they should be. But before I go into gaming, let's maybe wrap up this podcast by coming to the last chunk of the risk profile, risk control cycle, which is monitoring. And I get it, there's the big one is key performance indicators. And for the students listening, yes, the things I'm going to tell you, yes, you write them in the exam and that. But for the entrepreneurs, a bit of a different story. Like if you're going to have key performance indicator, maybe make one critical thing that you're going to determine if the person did a good job or not. It can help them to focus. It can help them to allocate their time to say, okay, that's goal number one. Yes, maybe I have to do side step 1, 2, and 3 in order to get that. So let's say your goal is bring in more revenue for the business, something very basic. Yes, maybe I have to spend time on talking to customers, attending conferences, doing these type of things in order to get to getting more revenue. And as the individual, I can decide how I should allocate my time across those things. Where compare that to say the wrong way, how I would recommend it, like this is what you shouldn't do, is when you get like micromanaged. Like, you need to have a revenue target of say $500,000, but you need to onboard at least 3 new customers. You need to attend at least 2 conferences. You need to do at least 5 seminars, and you dictate to the person how they should achieve their goal. No, rather tell them this is the goal, and if you've hired a competent person enough, they will figure out best how to get that goal. And remember, you're hiring someone who can do that task better than you can, because otherwise you should be doing it and somebody else should be doing what you're doing. So make sure that when it comes to key performance indicator, you make it simple, you make it clear, you make it defined, and you give enough trust and confidence to your team to figure out how to achieve that goal. So all these things I once had a friend that had this thing called the harvest system. They were always spending their time with the harvest. I was like, what is that? No, it was they had to log their time. They had to say how much time they spent doing each thing. And sometimes they'd get a work computer that had all this buggy software that was tracking their mouse and just making the whole work experience slow, and it can be externally activated and kept an eye on. And it's like, there's, like I said, those early morning meetings that are done specifically to make sure everyone arrives at the office at a specific time. And you have to give feedback in front of all your co-workers. So if you haven't made progress within the day, it's like a little bit awkward and embarrassing. And my whole pushback against this is it's oppressive, okay? It doesn't make a good risk working environment. And what essentially you're doing is you're looking at the risk of people and you're taking the risk of them being a sloth, laziness as the primary risk. and you're trying to manage this primary risk of laziness so much that you're creating all these residual risks of increasing the likelihood that your team is going to leave, okay? Increasing the risk that they're going to join the competitor, increasing the risk that they're going to, making other demands. So be careful of trying to manage in a certain way, and then, your monitoring is part of the management system. And I think that's the big trick here, is you want your monitoring to be different from management. So don't monitor the mouse tracking, don't monitor the time logging. Maybe if you're in I don't want to give specific industries, but if you're working in an industry where a low level of competency is needed and you've got a huge workforce across various countries and that, okay, maybe, there's a time and place for some of these things. But generally, if you're a startup or if you're a young tech company, having mouse tracking software and time logging, like I say, it's not going to create that risk environment that you want. Instead, and I think maybe because I'm thinking small team with my startup and I'm being a little bit blasé and ignorant to the big industrial complexes that might require all of this, because I would much rather have a monitoring system where it's a review, it's a meeting, it's a conversation where you ask, hey, are you happy? Okay, what do you need? Are there any improvements or suggestions? Give them room to suggest innovation. See if there is a problem. And then you ask that question, did you meet your goal? This was your key performance indicator. Monitoring, did the actual line up with what was expected? Okay, that's monitoring in a nutshell. If it's yes, recognize it, reward it. Maybe a salary increase, maybe more travel opportunity, maybe more time off. But you want to have something where you recognize victory. You want to incentivize that because you want that to happen again next year. And if no, ask yourself, okay, why didn't you meet your key performance indicator? Well, you can ask yourself, you can ask your team member. And ask yourself, can it be fixed? If yes, okay, and it's not too cost effective to make these fixes, then let's try again. Have a second chance. Or if no, if it's too expensive to fix or it's structural or, we can't actually do it, then you need to replace. And sometimes it can be better for the rest of the team to replace than to keep on a team member who's not pulling their weight, who is maybe a little bit of a sloth, because then the rest of the team is saying, if they're getting paid the exact same salary as me and they're hardly working, why should I work this hard? So replacement should be done in a way so that it motivates the team. It doesn't install fear and that. But again, I need to be careful with how I say this, because depending on the type of organization, depending on the workforce, depending on how dependent you are to your customer, your internal team, or the supervisors, will change and shape how you manage, how you monitor, how you measure. So this has just been a very generic, with I guess a bias towards startups, because that's the space I'm finding myself in. And for a large, my primary audience for these podcasts is myself. But just for those else who are listening, I think this is why people risk can become so nuanced, because it's highly dependent on the type of organization, the size of the organization, and the various things that surround it. But with that said, I think let's wrap up. We did pretty well. We managed to finish this entire podcast in under an hour. So I'm happy with that. And I'll see you guys all soon. Thanks for listening. Cheers.
You are listening to the Actuarial Business Podcast with MJ, the fellow actuary. MJ, the fellow actuary.